We should be starting now. This is Ron Williams, Technical Strategist at MIG Bank. Today we'll be looking at a very favorite subject close to my heart, gold and silver. Can everyone hear me? Just want to make sure that the sound check is okay. Okay, wonderful. So the title today is Will Gold and Silver Rocket into a Volatile Orbit? Now, I'll go into the different subjects that we'll be covering. If I could just have a quick, if some of you could tell me how many of you actually were at the last webinar that I gave, which was on black swan volatility, talking about oil and Japanese yen. If some of you could just say in the chat if you were there. While you guys are doing that, I'm just showing a quick disclaimer. It's quite important. MIG Bank kind of display this, and basically the short message is that any market views that I discuss during this webinar is purely for educational reasons and no recommendation to buy, sell, or hold any market. Okay, so some of you were here before. Welcome for those of you who have attended a second time around. I'd like to have a good and growing, interesting community that are keen to listen to the views that we discuss. But also a very big welcome to some of the new people who are here today. We really appreciate the opportunity to discuss the market. And right now I'll focus on, I'll come back to some of the questions at the end. We're happy to send information on the bank and any other questions related to what we discussed today. Now, I always like to begin any kind of presentation just giving a quick background on myself and the techniques that I follow. I've been in the market for officially over 12, 13 years. I started quite young, and during that time I've worked at various institutions. The key thing I want to highlight here is the time that I spent in the market isn't as much as some of my peers, but during that time there have been a number of market shocks which have increased the learning curve for myself and many friends that I know in the market. Now the techniques that I've learned to use over those 12 plus years are the ones on the screen at the moment. So if you can just quickly note this down for those of you who are interested. Market cycles, that's just basically market cycles in the market, long-term, medium-term, short-term, but also the interrelationships between different asset classes like currencies, commodities, and various other markets. Second and third techniques are more focused on timing, and that is Japanese candlestick pattern signals. This is an area that I've specialized in for many, many years, actually from the very start. And then lastly, the DeMark indicators and my own proprietary indicators, which we'll look at. These are the three areas that you'll see maybe throughout my presentation. Now, I'm going to start off just very quickly going into what's been happening into the market. Someone's asking, why do you think Soros has sold gold and silver recently? I'll go into the technical reasons for some of these reasons, for some of these questions. But let me just quickly give you a kind of overview as to what's happened. Gold and silver has obviously corrected quite sharply. Gold specifically having reached all-time highs at 1577.57, and silver, I'll just quickly jump silver, has corrected from a level last seen at the 1980 peak, which, as you all know, is near the $50 psychological level. Now, going back to gold, I just want to highlight that notably the DeMark indicator, which basically, for those of you who might not be aware, it measures exhaustion in momentum. So it looks for the end of a trend. And here you can see that on the weekly chart of gold, which was held within this very strong multi-year bull channel, there was a strong sell signal that came up from this particular indicator right at the top of the ceiling of this channel. So that was a key indication to me that gold was potentially reaching an upside exhaustion area. In addition to that, of course, we have the 1600 psychological level, which is just above. So that added a confluence of reasons as to why you might want to be cautious on being long gold or potentially think about taking a short position. So I've just written it just down here for those of you who like to kind of read some of what the points that I'm discussing. The market exhaustion signal near multi-year bull channel, 5% correction from the all-time high at the moment, and the all-time high was, of course, at 1577.57. The key support levels, I just want to quickly highlight Fibonacci support levels. and this is for the rise from January this year up to the peak. The Fibonacci support levels are 1474, that's 38.2%, 1442, that's the 50%, the halfway mark, and 1411, that's the 61.8% retracement. Now, 1411 is key for me as to whether gold signals a reversal of this trend or just continues sideways and then pushes back to all-time highs. So keep in mind 1411 is critical if you're wondering whether gold actually reverses in the short to medium term or if this is just a mild consolidation before a move higher. Now going back to silver, I think this is actually the more important market to be watching and I'll times during my presentation. Now the key thing here is that silver has made it has had an impressive gain on the upside, and as I said before, it's reached 1980 spike high levels near the $50 mark. Now it's done that in a very fast and impressive way. Just as fast as it rose on the upside, it is now falling dramatically on the downside. And one of the key things I've highlighted here is that silver has dropped 28% in just 4 days. 28% in 4 days. I'll say that one more time. 28% in 4 days. So that's obviously the high volatility characteristics of silver, which of course acts as a high beta to gold. Now, the signals that I was looking at during this time, although by no means was this a simple signal to follow, there have been various exhaustion signals along this way which have failed. The signal that has so far worked is a monthly DeMark exhaustion signal on the silver chart. So you see here, this chart here, just when we hit the $50 level or thereabouts, we had an exhaustion signal number 13 on the DeMark signal. That's an exhaustion signal on the monthly chart. Also on the daily chart, we had another indication of an exhaustion, and of course that was below the $50 1980 spike, and that led to the correction. Now, the key support level here is just one that I'm going to highlight, and that is 35.3364. That's the 61.8% retracement of the entire 2011 uptrend. So if we break below 35.3364, that implies that silver has lost almost 2/3 of what it has made since the uptrend starting in January. Is that clear to everyone? So if silver moves below 35.3364, that implies that silver has lost almost 2/3 of what it has made since the start of this year. I'm just reading a question here. Should we follow sell signals in this moment, in this market, or is this momentous? I would say, first of all, the trading decisions that you make is really down to you. It's a decision that you need to make according to your risk profile and your money management mandate, i.e. how much risk reward are you willing to take and how much money are you actually investing or trading with. But from an educational standpoint, I would say silver is actually producing a pretty bearish signal at the moment. Keep in mind this is a monthly chart, and this monthly chart had a very strong sell signal, which is still active. Also, if you look at candlestick signals, this is a bearish month, which is almost engulfing the previous month of April. And I'm just going to move on swiftly because there's a lot of information to cover. Now, the most impressive chart you will likely see this year, and maybe in the years to come, is the one that you're looking at right now. This is a long-term chart of silver going back to the late 70s. Some of you may have seen this. This is a chart actually I used to look at throughout my career. The one frustrating thing is I never looked at it actively to kind of think about the potential projection on the upside. But this is what we call in technical analysis a beautiful chart. And a beautiful chart in technical analysis is anything that shows some type of symmetry. And here you have basically the 1980 spike high when the silver market was manipulated and silver shot up pretty quickly, but then also capitulated quite sharply as well. Now, that entire capitulation then develops into what everyone now knows as a long-term base formation. There's this very long-term accumulation phase, which actually dropped below $4. Silver dropped below $4 around 1991 and 1993. And of course now, as all of you know, has now shot up to $50 back to the 1980s spike high. So I've drawn this dashed line in the middle just to kind of make the point to you that this very beautiful chart acts as a kind of a textbook and realistic symmetrical kind of base breakout. So someone's just said the Hunt brothers. Yeah, it was the Hunt brothers that actually cornered the market in 1980 and manipulated the price to create that spike. Of course, there are different reasons as to why silver has reached these highs at the moment. And actually, there isn't enough time to cover that, but I would urge that everyone think about the demand-supply dynamics in silver. If you look at the what silver is used for on a day-by-day basis, it has a huge industrial usage in semiconductors and various other things that we use within computers and many other technology areas. And also the whole speculation side of silver has increased somewhat aggressively. Now, I just want to quickly ask a question because I like to keep these sessions interactive. And this is a question I asked in a recent roadshow that MIG Bank did in Moscow, Russia. And I asked about 200 people in a seminar room how much they believed gold and silver has gained this year. So I would like to ask each of you here, it's just a quick survey. We have quite a few people in the webinar today, so if you could just quickly tell me how many percentage points, how much percentage gains do you think gold and silver has gained separately this year? So how much has gold gained and how much has silver gained? So I just want to get a few answers just so I can quickly get a good sample. So some people are saying 400% silver, someone says 650%. I just mean this year. So since January this year. Okay, how many people, what do you, so just some more? Okay, so some people say 40% gold, silver 228%. Some people say much more than that. Someone says a lot. Okay, the simple answer, 50% gold, 400% silver. So there's quite a good sample going on here. The answer, if you all want to know, gold has gained around 16% this year. So if you would have invested in gold since the beginning of January up until the peak in gold around 1557, you would have made 17% profit. Silver has actually extraordinarily performed 90%, almost 90% since January, more than 3 times or even more than that of gold. And that's a key point that I want to make. A lot of the people in the market are focusing on gold every single day. And most people in this chat probably have a good idea why gold prices are likely to increase over the next few months and next few years. Some people even talking about gold doubling in value over the next kind of long-term period. But not that many people are keeping in mind silver. And so if you remember one message from me in this very kind of short 45-minute webinar, keep in mind that silver is definitely the outperformer. It has proven so in a very big way in the last few months of this year, having gained 90% since January versus 17% versus gold. Now, the reason or the way that you can actually visualize this outperformance of silver versus gold is to look at simple ratio charts. And so this is what I actually do a lot of. Gold and silver are markets that I cover here at MIG Bank within our research team. And this is a long-term chart of gold versus silver. So someone's asking what is the significance of silver. I'll come back to that into a second. It'll feed through in further discussion. But if you can just look at this chart, whenever this chart moves higher, that's gold outperforming silver. And whenever this chart moves lower, silver is outperforming gold. So just think of it that way. Up is higher gold prices, down is higher silver prices. And the key thing to keep in mind is that in the last year and a bit, silver has, in a very impressive and aggressive way, outperformed gold. So you can see this big move from about 68 to about 32 or so is a major move on silver versus gold. And that key level that would have triggered your alert to this is a 13-year level which was broken. So basically this is a 13-year support level which silver broke, and that obviously kind of confirmed further acceleration of this move. So that's an important chart to look at, the gold-silver ratio. Now, part of the reason why this is happening is also due to macro changes in the market, which have been happening kind of almost every long-term cycle. So every 10 or more years, there's a shift in how we invest money. And this is a chart of the Dow Gold ratio. So this is the U.S. Dow Jones Industrial Average, so the U.S. stock market versus gold. Now, more than that, it's symbolic of the symbolic message behind this is whenever this chart moves up, whenever equity markets, U.S. equity markets and stock markets generally outperform gold, this suggests that there's a move to actually create wealth. So we want to increase our returns on our investment, so we start to invest in stock market and paper assets. So a lot of people here and may already know about this theme about paper assets versus hard assets. Paper assets are basically things that you invest in which can increase substantially in value. Hard assets are more things that you can hoard, you can keep to protect your investments. So this is a long-term chart of the U.S. stock market versus gold since 1920, and it shows you long-term cycles which move up, showing you wealth creation from 1930 to the 1960s, where the stock market outperforms commodities, and then 1970 into 1980, where people switch into capital preservation. So people are much more focused between the 70s and the 80s to preserve their money. Now, of course, the most important thing here is the most recent long-term cycle, and there are two cycles. One, 1982 into 2000, when we had the technology crash. That period was a big boom period where there was a lot of liquidity and a lot of wealth creation, mainly driven by credit, real estate, stock market gains, and many other fiat markets. Now, since 1999, since 2000, when we had the technology crash, we have had this silent crash on this ratio, which has crashed about just over 82%. So since 1999, since 2000, this ratio has crashed 82%, despite the fact that stock markets had a very strong bull market between 2002 and 2007. You don't really see that big appreciation in stock market on this chart. What you do see is that in real terms, you would have been better to invest in commodities or gold as opposed to the stock market. Does that make sense to everyone? Anyone have any questions on this? So just very simply, this is a very long-term chart showing you cycles between wealth creation and capital preservation, and that the way that we understand it is by looking at whether stock market appreciates versus commodities or vice versa. Great. So the important thing now is that obviously this ratio is still pushing down. These lines are regression lines. So this red line here going across is the mean of this entire move since 1920 to date. And this gray line here is +1 standard deviation, +2 standard deviation, and this gray line here is -1. So we're just below -1 standard deviation of this move and could very easily move even lower. So what I'm trying to say is that this chart also tells you that going forward into the future, possibly into next year, gold will likely continue to outperform the equity market, and we will likely continue within this silent crash, which will encourage more capital preservation. That's basically my message here and now and into the future. Now, partly the reason why we're switching into gold and switching into commodities, silver and various other precious metals, is because of this whole sense of currencies losing their value. And of course, this is partly down to the huge, gigantic debts which a lot of the Western countries around this world have accumulated over the years. The boom which took place between the 1980s and 99, and also which fueled this equity boom within this period, was largely down to credit and huge debt balances which were created in the US and the current not including platinum. The whole precious metal complex, the platinum, gold and silver, and various other ones. So here I have a chart of gold in dollar terms, euro in gold in euro terms, gold in Swiss franc terms, gold in Australian dollar terms. Now keep in mind that Australian dollar is a leading currency for driven by commodities. So Australia being one of the largest commodity producers. Also South Africa. This last chart here is gold versus South Africa, which is also a large commodity producer. And what you see here is that the trend since last year has been up in gold's favor. So gold has been appreciating against the currency gold has been the better value versus the currency. As currencies lose value because of the large debt that governments are building and the sovereign default worries that we're hearing about, gold is signaling that on the chart by outperforming against these currencies. But focusing on the here and now, you are getting some divergences. And here you see that the move in gold to all-time highs is actually more pronounced in dollar terms. So if you look at gold in dollar terms, you see more of a upside move on gold. And that's obviously part down to the major depreciation of the US dollar this year. The US dollar has depreciated about 10% this year. So obviously that will also add some further upside momentum to gold. And that's why this red line here has been quite a strong trend. But this hasn't been true when you look at gold versus other currencies in the last few months. So I want you to kind of just glide your eye, focus your eye on the short-term last few months that I've put an arrow against. So here you have gold in euro terms, and you can see here it's almost like a flat trend. It is making higher highs and higher lows, but not that convincingly. This is gold in euro terms. Even less so, and surprisingly to us, we're based in Switzerland here at MIG Bank. This is gold in Swiss franc terms. So of course you would maybe expect a Swiss franc to look a bit differently, because a lot of people use Swiss franc as a safe haven currency. And you can see here that Swiss franc is actually looking a lot differently when put against gold. So this is actually making a larger correction, and actually didn't make much of a new high when you look at gold versus Swiss franc. Now, this theme of non-confirmation on new highs is actually even stronger when you look at gold versus Australia dollar and gold versus South Africa rand. And Australia and South Africa are, of course, very key gold producers, the largest gold producers around the world. So what this suggests is strong non-confirmation divergence, suggesting that gold, this new high that we saw on gold, wasn't a very strong move, and may actually weaken substantially over the next few months. Now, I have other reasons as to why gold and silver may continue to correct over the next few months, and that's the next chart. So this chart, just keep in mind, it's currencies against gold. On a long-term basis, gold is outperforming these currencies, and that shows the devaluing of the currencies because of the high deficits, the high debts that each of these countries in the US, Europe, and UK have built over since the pre-2007 credit financial crisis. But in the short term, it makes the point that gold has made new highs more in dollar terms and hasn't really confirmed in euro and Swiss franc, and there has been no confirmation in the commodity producing currencies, Australia and South Africa. So suggesting a correction over the next few months. Now, I just want to quickly focus on the dollar itself. I have a webinar coming up in early June. It might actually be up on the FXStreet website. Please check afterwards if you want to sign up for that. That'll be in early June. And that'll be on euro dollar and the US dollar and everything related to the dollar. So please, if you're interested to that, sign up. Now here, I've included just a quick chart because of course it's relevant. This is the US dollar index. So the US measured against trade-weighted basis against various other currencies. And of course, this shows you that this chart goes up, US dollar appreciation. This chart goes down, US dollar depreciation. And this move here, since January to date, is the 10% depreciation in the dollar. So this is January 2011, this is now, and that's a 10% decline. So that's partly why we saw this big upside move on gold versus US dollar. In my view, this move, this depreciation, as you probably already know, was triggered by a major of the year. I have various reasons for that, and maybe if you follow our research, you can read as to why we believe that, why I specifically believe that. One of the reasons why I believe that is because of, or one of the confirmation signals I look at, is because of speculative positions which you can get from the COT exchange in the States. And that shows you the net long and short positions which people are taking out, which non-commercial, so kind of hedge fund related money is investing and trading in the US dollar. So this big up move is showing you a big investment and trading in the US dollar. This big down move is actually a historic move to extreme in short positions in the US dollar. Now, right now, we are unwinding from this historic extreme position, and I think that if this continues, we might actually see a move above zero into the plus area, where you see a lot of scaling back of short positions on US dollar and a lot of actually new trading back into the US dollar. Now, traditionally, people invest in the US dollar during risk-averse environments, and some people usually look at the US dollar as a safe haven. That hasn't been the case over the last few months since January, when we had the 10% depreciation, and partly that was down to the fact of this, large mounting US deficit, which has been on everyone's mind. So a lot of people have been shifting out of US dollar. But technically speaking, I believe that this move is now oversold and might actually start to push higher. Now, someone's asking, would you please explain the logic behind yen and US dollar correlation or inverse correlation? We often hear that the main driving force for the pair are interest rates and bonds in both the US, Japan, and whatever that means. How about this? When the market is in search of a risk appetite, treasury bonds yield will rise as interest rates fall. How can we make sense of this when making trading decisions? And know the topic is gold, silver. Okay, that's quite a long question. I'll answer just one or 2 points within that question. Basically, a lot of the currency trades amongst the big currencies now, US dollar, euro, and sterling, is a fight for low quality trades. There isn't much quality yield to make at the moment in the market, and that's partly because government interest rates are at historic lows. So when you invest in a currency in order to make high interest, high yield on that move, historically there's been a good divergence between these currencies that you could actually trade and make money out of. Now, that hasn't been the case, of course, because governments have lowered interest rates to historic lows to actually stimulate the economies ever since the 2007-2008 credit and financial crisis. So they're trying to kind of allow money to be cheaper, to allow banks to lend more money so that we can spend more money and revive the economy. Now, that's the economic kind of backdrop. What has happened is the euro has gained value versus many of the top three currencies, mainly because the euro or Europe has the more aggressive interest rate hike policy. So Europe is the ECB, as you may have heard today and recently, is the more aggressive central bank, which is increasing interest rates, whereas the US is seen as less likely to do so. And if they do increase interest rates, it will likely be early next year. So this is the interest rate differential argument is partly what's driven the dollar lower and the euro higher. I'll talk more about this in my next webinar in early June, which will be specifically about euro dollar and various currencies. But just if you can look at this on a technical basis, the US dollar has depreciated in value minus 10% since January to date, mainly because of this kind of big deficit problem in the US, which we keep on hearing about, and also because currencies like the euro have actually a better interest rate yield to offer if you're investing in that currency. But on a technical basis, and this is very important, I believe that this fall in US dollar is actually becoming oversold, and I believe that we are due a rally, which is actually potentially going to take place over the next few weeks, next few months, in the summer period. And some opening confirmation of this is liquidity indications that I look at from the COT, which shows the net long and short positions given by hedge funds in the market. That shows that we are unwinding at the moment from historic extreme lows. Okay, so my technical view here is that the US dollar will likely appreciate over the next few weeks and months. That will, of course, add some pressure on commodity markets because of the relationship, the inverse relationship between the US dollar and gold and silver and various other commodities. Now, the other reason I want to stress is that gold and silver and various commodities are also influenced heavily by seasonality. So the months in the year influence the stock market, influence commodities, and they also influence currencies. this chart here is a seasonality. It's basically like gold's performance over the year, and you're looking about 10 separate years on the chart. Is that clear to everyone? So you're looking at a seasonality chart of gold. Each of these lines is showing you 1 year's worth of performance, and you're seeing 10 years worth of isolated price performance. Now the scale, it's very important to understand the scale. This is the percentage price gain or loss. So this is 10% gain in gold, 20%, 30%, and then this is minus 10%. And very simply what this shows is that, of course, gold gains in value traditionally during the August to winter months. So please write this down for those of you that maybe have heard this for the first time. Gold gains value traditionally between the late summer into winter and Christmas season months. Now the main reason, and that's why of course you see here the green lines which I've highlighted here, it shows you that gold overall gains between 0 to 40% or thereabouts during these months. And so that's just a seasonally positive period for gold. Now partly the reason behind that is due to the whole demand dynamic that drives gold. And of course wholesalers start to buy gold aggressively during this period, during the late summer to winter period, mainly because of the increased demand in countries like India and China, specifically India during wedding season, when of course a lot of their weddings involve dowry exchanges, which means buying gold, and also during the Christmas season, where most of the Western cultures buy gold to exchange presents with their loved ones or friends. So a lot of this increases physical demand for gold. And keep in mind that physical demand for gold is worth about 50% of gold's demand. Now, the key point here, thank you, someone just said it's interesting, so it is important to keep in mind, I mean, I do look at technical analysis, over my entire career, but it's very important to understand the economic and demand-supply dynamics behind all the markets you look at, foreign exchange, commodities, rates, all of the markets. Now, there is one key point that I want to make here. During the spring to summer period, this period here, so if you see April to July and maybe some of August, gold and most commodity markets, specifically precious metal markets, don't perform that well. They underperform, or they move sideways. They don't do much. So that, in my opinion, adds more potential pressure to the correction that we're seeing in gold and silver. So commodity prices, in my opinion, including oil and various other commodity markets, are likely to lose value over the next few weeks and over the next few months into the summer period, when liquidity starts to decrease in the market. People take holidays, but also when demand starts to decrease. Now, oil has a separate story behind it, but certainly in the case of gold, this is true. So keep that in mind. Between spring to summer period, there tends to be a decrease in value for gold, and certainly in the late summer period, usually end of August, early September into winter, that's when you get a big increase, up to close to 40% increase in gold. So if you can calculate that in gold terms, you can work out roughly how much gold can gain value during that time. Now this is also true for silver. So this is the same chart but for silver. You're looking at 10 years worth of price performance on silver, but each of the lines is 1 year. And if you want to see the individual years, just follow these lines. 2007 is the light blue line, 2011 is the white line, which is just finishing right now, and the blue line is the average. So this is the average. By the way, all of these charts will be available on the MIG Bank website afterwards, later on next week. So if you are interested in these charts, we can share them with you over the next few days. Now what this shows here, we don't have the link yet, but I will hopefully have a link prepared for the next webinar. There wasn't enough time to prepare it for this one, but we will prepare a link going forward. Meantime, we will create a link next week on the website, on the bank's website. Now, at the moment, silver looks a lot more interesting. Now you see the gold chart. Look at the scale: 0 to almost 40% during the high seasonal period, high performance seasonal period. Silver 0 to 80%. So clearly, versus 17% on gold, due to the silver gold ratio, the gold silver ratio. But this is showing you on a seasonality basis over the last 10 years the range of price performance on silver. And you can see that silver may likely correct over the next few weeks and months quite sharply, and it will be a scary correction. I will talk about why this correction will be quite scary. It's already dropped 28% in just 4 days. So if any of you who have been buying silver, obviously 28% move down against you in 4 days is quite scary. Now, even though it's quite scary, you have to kind of have to accept the fact that that is just the characteristic of silver. Silver is a highly volatile market, and although it's corrected quite dramatically on the downside, that also, in my opinion, will create a wonderful buying opportunity into the end of this year and certainly into next year. And this chart, the seasonality chart, just shows you how much higher silver can gain in value during those months. So during the second half of this year and certainly early next year, in my opinion. Now, one of the things I want to focus is that, I'm very positive on gold and silver in the long term over the next few years, and more specifically the end of this year and into 2012. But keep in mind that right here, right now, I believe that gold and silver is very, very, very overextended. The correction that we're seeing on gold and silver is evidence of that. And one of the things I learned from a mentor of mine in one of my previous employments, he used to often say to me that acceleration is unsustainable in the short term. Acceleration is unsustainable in the short term. I'll say that one more time. Acceleration is unsustainable in the short term. So all that means is that any market that moves up in a straight line, I'll quickly go back to silver. So here you can see silver moving up in a straight line, a big move over a few years. This move will be unsustainable in the short term, and so that's why we're getting a correction in silver. Now silver can move down to around the $27 mark, even lower down into the 20 psychological level. But this will, over the end of this year and early next year, and certainly over the next few years, be a wonderful buying opportunity, in my opinion. You'll need to wait for confirmation, of course, before you look for buying opportunities in the future. But just keep in mind that this volatile, very dramatic correction, 28% in only 4 days, and more to come, will provide a very good buying opportunity around these levels, around 27 and certainly around the 20 area for long-term investors. That's obviously also true of gold. Now, having said that, in the long term, so just so everyone's clear, this is long term. In the short term, everything that I'm saying is the exact reverse. If you are buying these markets, you are taking on a great return. You're making a lot of money, or you were making a lot of money, but you're also taking a lot of risk. And this is a little chart that myself and the next colleague of mine developed about a year or two ago, which just theoretically highlights what happens when we're making money at a faster rate. Now, everyone in the market likes making as much money in a very short space of time. Everyone wants to buy the Ferrari tomorrow morning, and everyone wants to make lots of money very quickly. Now, because of this need and this human nature, this human drive for greed, to make lots of money very quickly, we tend to take on more risk than we should when we're making a lot of money. So just think about that. When we make lots of money, we get greedy, we buy more, we ignore a lot of the strategies or a lot of the kind of warning signals that we might see in the market because we're making money. So we start to trade and invest blindly. So think of yourself as driving a car without seeing in front of you. Now, the reason why you would drive a car without seeing in front of you is because you love the car. And that's what happens when you're trading markets like gold and silver. This is what happens psychologically. Now, theoretically, what we see here is that this is, let's say, a stock market or a commodity market rising in price. This red line is showing you the risk-reward ratio. So as this blue line represents price, as the blue line increases in value, this is showing you price gaining in value, any market. But let's just say this is gold and silver. Now, as the price value gains gains higher, we start to trade more, but we also start to take on more risk, and that's why this line starts to look a bit more vertical. So this is when we make more money, but we also take on more risk. Is that clear to everyone? Someone's just said neat example. Great. That means it makes sense. Now, a lot of us, I would say the conservative place to be is within this blue area. Think of it as the equilibrium area. So this is where you can still make money, but have a conservative amount of risk. The problem is that most people in the market, certainly private investors and the hedge fund community and people who like to make a lot of money in a short space of time, like to trade in this area. They trade through this whole area, but then they decide, what the hell, let's trade even higher because we can double, triple, quadruple our money in an even faster way. So they stay on that trend during this period. Now this is a big problem because of course this means that you take on a lot more risk with that increased reward. Is that clear to everyone? Okay, I think most of that's clear. Now I love to show pictures to explain what I mean by some of these theoretical explanations. And the best picture I can come up with is this. This picture is one of my favorite pictures. A picture speaks 1,000 words. And this picture here is builders back in 1932, just after or during the big industrial boom in Wall Street in the U.S., when they were building lots of skyscrapers and lots of industrial buildings and industry. And what this shows is on the Rockefeller skyscraper, you see here that this, or Empire State, I'm not sure which building this is, I think it's Rockefeller. You see these builders basically taking a lunch break. This guy here is having a bottle of whiskey. This guy's reading newspaper, having a chat. This guy's having his lunch. But the point is that they're very comfortable, even though they're very high up in the sky on this skyscraper with nothing beneath them. Now, how many people in this chat room would be scared to sit in their places? Open question. We have a few minutes to finish. Okay, so a lot of people are saying it's like when we trade, and it's exactly like when we trade. And it's important to think about this because this is what's happening right now in the market. A lot of people are very comfortable in the trades that they're in, and that's because they're making money. A lot of people are comfortable even though we've had kind of big market shocks like for example, the Middle East revolution, which kicked off early this year, and then the earthquake in Japan. And of course, the mounting sovereign debt defaults, which we've been hearing about specifically in the US and European market after the 2007-2008 financial crisis. Now, despite these big market shocks, we have still decided to invest in markets. We're still very optimistic. And if some of you look at some of the indicators that I look at, like, for example, the VIX volatility index, which is at a 4-year low. So this is a chart which I mentioned in our recent roadshow, MIG Bank's recent roadshow in Moscow, Russia, where we basically made the point that volatility index was at 4-year lows despite these market shocks that we've seen. Now there's a question here. I missed a little portion of your speech. Sorry if insistent. Is it true that there's not enough physical gold? I'll have to come back to that. So some of these questions will be on the back of the MIG Bank website. We will upload some of the answers to some of these questions. There's a lot of people in this forum today, and we're very happy to have you here, but it's very hard to answer all these questions in the time that we have. Going back to the point, I was just talking about how optimism is at extreme highs. Everyone's very comfortable at the moment, despite the market shocks that we've seen earlier this year. And I was making the point about the market shocks we've seen on the back of the revolution in the Middle East, the earthquake, the tragic earthquake in Japan, and the increased legacy sovereign debt defaults that we've been worried about in the US and in Europe. Despite that situation, we have been very similar to these people that are sitting on this skyscraper in the 1920s taking a lunch break. Now, they're very comfortable. They've been absorbing all these market shocks, and they've become used to it. But keep in mind, one of the statements that I came up with about a year or two ago, the first step in risk management process is to acknowledge the reality of risk. So even if you're making money at the moment, which is great, even us when we're, for educational purposes, recommending certain trade positions, we follow the trends, we follow momentum, but we always keep in mind when we're adopting more risk. Now keep in mind the diagram I showed you before, which shows you that you're making lots of money in a short space of time, but as you do that, the line then starts to turn vertical, and then you take a lot of risk. And the best optimum place to actually remain trading is within this blue area, where you can still make money, but not take more risk than you should. And that, of course, is where we are in silver. I'll just quickly show you that silver chart, just so you remember. Silver has done that, gold has done that, and many of the precious metals, including platinum, and various other markets have done that. So although you're making lots of money on the upside, keep in mind that this acceleration is unsustainable in the short term, and we're likely to have a correction or consolidation over the next few weeks and few months. I actually believe that is also down to the fact that the U.S. And the Federal Reserve are now talking about potential exit strategy into June summer period, when they're actually going to change their policy on interest rates and in funding the economy, and that will take the Bernanke put, or the comfort zone, out of the market. If it happens, I think that will take the comfort that we've been feeling out of the market, and then some people might start to shift away from high risk investment to more conservative safe haven investment. So keep in mind, the first half of this year has been all about high risk investment, because we've become used to the picture which I showed you. But keep in mind, you're still sitting on a skyscraper, and it does pay to actually acknowledge the reality of risk. Now I'm just going to quickly show you, stress the long-term, the amount of money that the government's been spending does produce inflation. And so this inflation will likely devalue the currencies even more. Remember, I showed you the chart just here of various currencies in gold terms, and this shows you that, of course, the gold has outperformed these currencies, showing that gold has gained value against currencies which are losing value. But if you look at gold in inflation-adjusted terms, you can see that there is further upside to go. So although there's a short-term correction due over the next few weeks and months, if you adjust prices to inflation during the 70s and the 80s, there is still lots more upside to come when we reach that buying opportunity end of this year and into next year. Now, the chart that actually looks even more stunning than gold, and I hope you remember this, is silver. Now, this is silver in inflation-adjusted terms, and it shows you that everyone is talking about silver reaching the high at $50 or near $50 in 1980. $50 is not actually the real inflation-adjusted value. If you have to take into account inflation. And of course, in 1918, 1970s, inflation was quite high. It was actually dramatically high. And so the value of a cinema ticket, the value of food, the value of just about everything was very high. So you have to take that into account, especially when you're making comparisons to historical prices. And so the historical value of silver back in 1980, the most widely quoted number is actually around about $140. So I'm not, and again, for legal reasons and disclaimer reasons, I'm not saying that is a target, but I'm just saying that's a yardstick. That's a potential upside, move that you can keep in mind that silver can do. So silver during the 1980 peak was actually almost around some people say $140, $150 an ounce. So that just shows you the long-term upside in silver. So just keep in mind, this is a chart here of gold in inflation-adjusted terms that shows that there's still more upside to go. It can even go above this level, in my opinion. And silver, there is still a lot more upside to go when you see this peak, which you'll get different numbers according to how you calculate inflation adjustment. But one of the figures which the notable Jim Rogers, one of the big commodity gurus out there in the market, quotes is $148 in 1980. So we are substantially lower beneath that. Now, this reaches the end of this fantastic and exciting webinar from MIG Bank, Ron Williams, technical strategist at MIG Bank. And one of the things I just want to quickly remind you is that if I haven't been able to answer your questions, I might be able to try and answer the questions now, but if I don't have time to answer the questions, please email me on here, r.william@migbank.com, r.william@migbank.com, and I'll do my very best to get back to you. We will post answers to the questions on our website, and of course we can spend more time doing that. We will also put some of the charts that you saw in this presentation online, and also I've been told by our marketing department that for those of you that email us, we can also set you up for a 1 month free trial on our research reports that we write on a daily basis. On my side, I cover the major FX markets, also gold and silver, and soon we'll be covering CFDs, which include some of the industry markets and oil and so on. So I hope that's been interesting. I hope that's been valuable, actionable information. Thank you very much, FXStreet, for inviting me to host this seminar. It's been a pleasure and an honor, as always. And please remember that there will be a webinar scheduled early June. I think it's June 1st or 2nd, and that will be talking about Eurodollar, where next. So if you do want to attend that, please, early June, June 1st, 2nd, I think. I can't remember exactly. That'll be on Eurodollar, where next. Thank you very much, everyone.